Good morning, everyone, and thanks for joining the call. On behalf of Reliance Securities, we welcome you all to Reliance Nippon Life Asset Management 4Q FY19 post-results conference call. We have with us today the management team of Reliance AMC, represented by Mr. Sandeep Sikka, ED and CEO, Mr. Prateek Jain, CFO, and other senior members of the management to discuss earnings for the quarter gone by and key business strategies going forward. So over to you, Mr. Sikka.
Good morning to everyone and welcome to our Q4 FY19 earnings conference call. We have with us my colleagues Prateek Jain, CFO, Sugata Chatterjee, Co-Chief Business Officer Distribution, Ashwin Duggal, Co-Chief Business Officer Institutional Sales. I would also like to take this opportunity to welcome to our team a senior member from Nippon Life, Hiroshi Fujikaka-san, who just recently moved to Mumbai from Japan. During the financial year, MF industry faced multiple headwinds, right from long-term capital gains tax on equity, higher crude oil prices, adverse credit events, regulatory changes, liquidity tightening, and election year, etc. Despite all these challenges, our bank continues to deliver strong foundation, stable management team, prudent risk management practices, robust processes, and maintaining highest standard of compliance, cutting-edge digital architecture, and customer-centric approach. I'm happy to share for the quarter total income I'm happy to share that for the quarter total income at rupees 3.97 billion, while the net profit rose by 34% to rupees 1.51 billion year-on-year. Also, for the full year FY19, our net profit is rupees 4.86 billion, up by 7%. Over the past 1 year, there have been two major regulatory changes with respect to TR reduction. The first reduction was with due to exit load from 20 basis point to 5 basis point. Second being revision in TR structure applicable from 1st of April 2019. As mentioned in a previous interaction, the impact of the first reduction has completely been passed on. The impact of the recent revision in TR is 12 to 13 basis point on our equity sales, which will also be passed on to the extent of 80 to 90%. We remain committed towards a journey of profitable growth and continued focus on retail assets. Retail was the fastest growing segment and contributed to more than 50% of the industry growth. We continue to have the highest retail AUM of rupees 900 billion, driven by strong ground presence, robust distribution network. Further, our retail assets have grown highest in the industry at rupees 167 billion in last 12 months. Our retail average AUM contribution to total AUM is amongst the highest in the industry, which stands at 39%. Despite volatile markets, our annualized SIP investment, systematic investment plan, the total book is now, annualized book is at rupees 103 billion, grew by 14%, and the SIP count increased by 21% to 3.1 million. Over 78% of the incremental SIPs have a tenure of greater than 5 years. I am pleased to share that our equity SIPs, including ETF, rose by 13% at 1.08 trillion. Our folios also grew by in excess of 12% to 9.1 million. We continue to be amongst the leaders in beyond top 30 city segment. This segment contributed AUM of more than rupees 450 billion. Nearly 20% of the assets are sourced from this segment for our NAM. Compared to the industry, this number is 15%. On our distribution front, I am happy to inform that we have partnered with Google to launch voice-based financial transactions. Our investments in digital ecosystem have been yielding results as our digital purchase, including SIPs, rose to 1.1 million in FY19, a growth of 47%. On average, Reliance Mutual Fund processed one online purchase transaction every 30 seconds. Over 1/3 of the transactions are happening on our digital assets and integrations, which is double the growth over the last year. Company has a vast pan-India distribution network with presence at 300 locations. We continue to focus on locations beyond top 30 cities as assets from smaller locations have higher persistency, are more sticky, and are more profitable. Our NAM remains well diversified in terms of distribution, with no single distributor contributing more than 5% of the total assets of the mutual fund AUM. Our distributor count went up from 65,300 in March 2018 to 73,400 in March 2019. As an asset management company, we also operate in ETFs, alternative investment funds, offshore funds, and let me share a brief update on all these business lines. I am very happy to share that we have successfully raised rupees 27,000 crores via two further fund offers of CPSE ETFs with the participation across all investment categories, out of which 10,000 was raised in March 2019 as a part of FFO4 of CPSE ETFs. RNAM is the second largest ETF player with a market share of 18% in the ETF segment. It has an AUM of in excess of rupees 211 billion for the quarter ended March 2019. Reliance AIF launched industry's first commodity fund and offshore real estate fund for investors in Japan. Reliance AIF has commitments of over 25 billion across various AIF schemes. RNAM is also managing and advising an AUM of rupees 86 billion from offshore investors. During this period, we launched UCITS India Income Fund based out of Dublin. Also, the UCITS India Equity Fund is in the top quartile and is in excess of 300 million. Nippon Life has investments in asset management companies across the globe, and we continue to work closely with Nippon Life Insurance to leverage their global tie-ups for attracting higher flows from international investors. We believe this as an opportunity for attracting higher share of flows into India as a part of our profitable growth strategy. Our subsidiaries contributed around 100 crores of revenue because of all the international operations. Company continues to get recognition and recognized by agencies for the Best Fund Award under the Large Cap category by CNBC 18 Scotch Award for Fund House of the Year with the highest retail reach, and the Best Digital Transformation by Asia FinTech. I am happy to announce the board has approved the second interim dividend of rupees 3 per share. With this, the total interim dividend would be rupees 6 per share. As a part of our stated dividend policy, we will continue to share 60 to 90% of the profits with the shareholders. With most of the challenges probably behind us, we expect brighter days ahead. Indian asset management industry has huge potential to grow across all segments, that is mutual funds, alternative investment funds, ETFs, offshore, given the under-penetration of AUM to GDP at 12% against the global average of 62%. And mutual funds, still only 2% of the population is investing in mutual funds. We are in a state of readiness in terms of product and fund management capabilities, ongoing presence, and distribution network for AUM and profitable growth in the coming quarters. Before I open the floor for questions, I would like to also talk about the recent newspaper article about the stake sale of RNAM. Reliance Capital has informed the stock exchanges that about their intention to exit this business. Over the last 7 years, Nippon Life has remained committed and has increased the stake 4 times, and their commitment to India continues. As I understand from Reliance Capital, they will be signing a definitive agreement with the new shareholder anytime in 4 to 6 weeks. Because of regulatory reasons, I will not be able to touch anything more on this point and will not be able to take any further questions on this topic. However, with these comments, I'm happy to take any other questions. Thank you very much.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may please press star, then 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star, then 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star, then 1. The first question is from the line of Subhranshu Mishra from Bank of Baroda Capital Markets. Please go ahead.
Good morning, sir, and thank you for the opportunity. Couple of questions. The first one is with regards to your strategy of upselling to customers during the product life cycle. What kind of strategy do you have for that, sir?
Okay. you mentioned a couple of questions. Continue with all the questions that I can
I'll take it one by one, sir. Actually, multiple questions.
I think from our perspective, I think we clearly believe, I think as a asset management company, we have a complete suite of products. Typically, as you can see, we have been operating across all segments, especially very strong on the retail side. Typically for us, I think across the life cycle of the investor, I think we have basically, the new investors typically come into through SIPs, and as a part of the both using business intelligence and strong on-ground distribution capability, we've been trying, and also using SaaS, we have been trying to upsell multiple products and also top up the existing. So we are also, I think clearly we have seen the Indian asset management industry evolve. We have seen existing investors who started from one SIP, also adding multiple products, coming into multiple asset classes, and also the higher end moving into ETFs and alternate investment funds. So I think it's a complete product suite that we have, and depending on what is right for the investor, using our branch network and with the help of our advisors, I think we are in a position to offer all the products to the investors.
Provide us for the percentage of upsell versus the new business acquisition?
At this point of time, every investor of the company has invested in more than 1.6 products.
Okay, sure. And so the next question is with regards to your cost of acquisition using an IFA. What is the cost of acquisition using an IFA in a B30 location versus a T30 location?
I think while I will not be able to give you exact numbers, but typically the cost of operations in smaller cities is much lower. I think in the smaller cities, the key lies in the execution. And I think once you've got the execution and the scale, the economies of scale come to play. So overall, the cost of acquisition and operation in smaller cities work to your advantage.
Okay. And there's one more question with regards to one of the largest distributors applying for an MF license, and NJ Invest in this case. How do you see that panning out as in terms of competition going forward? So because they've got a large workforce, both off-roll and on-roll.
I think I clearly see in India only 2% of the population investing in mutual funds. Right. We have at this point of time, while we have 45 mutual funds, the top 10 mutual funds have average AUM, I think in excess of 80% market share. Right. I think just like US, I think I clearly believe there is scope for many more asset management companies to come. There will be various niche which will be available, and I think we need more players, which will help the growth of the industry.
Right. And just one last data keeping question. Can you split your retail AUM sourcing into IFAs, national distributors, and banks?
52% of our business is retail.
So that's the total AUM, right? As I'm talking about specifically retail AUM, sir.
I think we'll give
predominantly retail. It is predominantly through IFAs. Retail is predominantly through our IFAs only.
Okay. Sure, sir. Thank you for your time, sir.
Thank you. The next question is from the line of Ankit Pawan from IIFL. Please go ahead.
Hello.
Yeah.
So thank you for the opportunity. I want to ask on the sustainability of lower operating expenses reported this quarter. So the numbers that are shown is 62.18 crores, which is significantly lower than the quarter-on-quarter and year-on-year numbers. Can you please comment on that, whether it's going to be sustainable going forward as well, or are we going to see an uptick in that? That's one question, sir. Second thing is, you mentioned that the TER reduction is 12 to 13 basis points, and then 80 to 90% of it will be passed on. Can you please give a little more details on in terms of equity funds separately? And what will be the total earning on the equity funds AUM and in percentage of basis points? That kind of thing. Thank you.
Sure. Thank you. This is Prateek here. First of all, I take this question on the sustainability of expenses. So this is the first quarter post the regulation, SEBI regulations are announced. And if you look at it, the upfront commissions which have been stopped, most of the expenses in terms of the marketing spend which we used to work with distributor in terms of contests, etc., by regulation it has been stopped. And therefore, if you see this first quarter, the expenses numbers in terms of brokerages, whatever you see, is of the prior period amortization, and which will also come down gradually. So in terms of the carrying forward number, that number will be far lower than what appears in here, because from October onwards, we are not paying any upfront commission. Two, in terms of employee cost, this has been sustainable and it's been continuously on the similar rate. In terms of other expenses, as I mentioned to you, some part of the expenses have moved towards the in the scheme. And other part, we have been curtailing and putting up a rationalization on our discretionary spend, and that has brought in these kind of savings. And this quarter can be seen as a reflection of expense accounting going forward, sans the fee and commission expense, which is the amortization fees, which will further go down from here. In terms of equity fund, if you see, as you're aware, most of the industry players have decided to pass on majority of the TR cut. And for us, both our AUM are broad-based in terms of various schemes. None of the schemes are concentrated. Also, in terms of our distribution, if you look at it, none of the distributor accounts for more than 4 to 5% of our total assets. And therefore, if you see, it'll be a little more easier on our part to pass on this TER impact, both in absolute and in basis point, compared to some of our peer groups who has larger schemes and also higher amount of equity comparable to us. And in terms of the overall impact, if you look at, let's say you will take an example, to explain this process, that earlier, even if 10% of the asset was incremental flows and you were paying upfront on it, there was a cost of almost 100 basis points, which works out, let's say, 10 basis points, if you work out that math. And it was to be amortized over a period of one year. Going forward, if we say the same assets comes in and we divide this and we say that we'll pay the entire upfront or to be allocated over the next period of 4 years, then the impact of 10 basis points gets reduced to 2.5 basis points.
Yeah.
So this is just the mathematics, but in practice, what we've been working out is that we are working out a pure sharing model with the distributor going forward, and therefore the impact, there will be a positive impact of the realization on the assets.
Sure, sir. Thank you.
Thank you. The next question is from the line of Amit Nanavati from Nomura Securities. Please go ahead.
Yeah, hi sir. So just on this brokerage expenses or the commissions that you pay out to distributors, this time around you've reported those numbers under fee line item, and I see a relatively smaller drop when I compare 4Q versus 3Q, or even compare to first half where your run rate was around 60-62 crores, which is a similar run rate that you see in 4Q. So is it fair to assume that you had very limited new flow drag in first half 19?
Yeah, so comparable to the last year, if you see our amount which we have garnered in the first half was comparatively lower, and therefore this impact which is coming in is because of the flows which came to last year second half, and that has been amortized equally over a period of 12 months.
Correct, but if you look at first half run rate versus 4Q run rate, it is pretty much similar, which would mean that first half, when you were allowed to pay upfront commission, that drag is absolutely not there.
No, so what has happened is that since this was already announced by the regulator, only the implication or the implication has been from 1st April. Most of the distributors started coming in a pure trail model in the beginning of the year itself, especially the IFAs.
So what percentage of your incremental flow or before this regulation change was on full trail model in equity?
So almost 1/3 of the assets was on the full trail model already prior to last year February, before the regulations were announced.
Of the flow or the assets, sir? Sorry.
On the assets, and so in the flow as well. Yeah.
Okay. And second, I see a decent moderation in IFA addition quarter on quarter in the last 4 quarters. Anything to read into that, especially coming after the large TR cuts that has been announced?
No, I don't think so. You should read too much into it. This is more a function of typically, I think when the markets are doing well, I think that you have more new people joining the industry. So I don't think so. This should be seen as a TR. It's more a function of when I think the investors are the markets are doing well, investors are making more money. That's the time that natural pull is there and more people are coming into the industry. So don't read too much into it for regarding the TR. I think this is just being a cyclical business. You'll always have these patches, and if you were to see over the last 10-year period, you've had 1 or 2, 3, 4 quarters like these many times before.
Okay. The reason I'm asking is because the additions in IFAs is coming off, and if you look at banca share in your overall EM, that has also been coming off. So, just wanted to get some sense of whether banca is distributing less, and then you have difficulties in adding IFAs also.
No. I think the way you have to see is overall. Typically, I think we've always been a more IFA driven. It's not the bank are selling less. Overall, during this period for the industry, banks we saw HNI flow slow down, and typically HNI flows come more from the banks. So that's the reason. So that's why I said don't read too much. This is a very whether a few thousand plus minus new IFAs getting added. This is I think the way we see it is as we are getting into new cities and towns. I think there are a lot more people who want to join this industry and take up this as a career.
Thank you, sir. That's it from my side.
Thank you. The next question is from the line of Madhukar Ladha from HDFC Securities. Please go ahead.
Hi, sir. Congratulations on a good set of numbers. Good to see, expenses falling. A couple of questions on my side. So I see a sudden jump in trade receivables from around 40 crores to 102 crores. This is year over year. So any particular reason for that?
No, so this is just the fees for the month, and the balance fees which was receivable from the mutual fund scheme of ours. There is no other receivables outside the mutual fund. 99% of our receivable is from our own schemes.
Okay. And the other thing I noticed is there's been a drop in the short-term loans and advances. Last year it was about 646 crores, and now it's about 370 crores. So did we receive any payments from the Anil Ambani group companies?
Yeah, so we, earlier from 440 crore of ICD, we have brought down the total group exposure to 380 crores.
Okay, that's good. Also, in your earnings, I'm seeing the reconciliation of equity and PAT from IGAP to NDS, and in the equity portion, there is improvement or an increase in equity due to change in fair valuation of financial assets, about 57 crores, whereas in the full year earnings, there's a drop of about 60 crores. And there is also a particular line item in equity called scheme consolidation, which is contributing 65 crores to equity. Can you explain those items a little bit?
Yeah, sure. See, first of all, on a principal basis, if you see the fair valuation, which was we have taken it to the balance sheet because those were not to be passed from the P&L account, and therefore, if you see in P&L, it will be a minus, and that will get added to the balance sheet as on the opening date. So that is the you have to directly adjust to the reserve rather than taking to the P&L of the increased mark to market pertaining to the previous year, and therefore that adjustment has been carried out as of for the March 18th number.
Okay.
Second part is the any investments which we have done in our own scheme, where because of the India there are three tests which we need to carry out. One is the control, and since this is our scheme and we are the asset manager, our auditors have said that it will be treated as a control. Though from a SEBI regulation there is not much of a control because this is a separate entity and there is no voting rights to it. But from an accounting perspective, it is seen as a control. Second is variability of return. So it is a completely variable because whatever is the return of the scheme will be the return of ours. And if we own more than 37% of that particular scheme, in such cases, it will be consolidated to us. Now what happens is it's only in certain schemes. See, we have a regulation which does not allow us to be beyond 20% of the total scheme value. However, in ETFs and in the new AIFs where we are seeding businesses, we are allowed to put more, and over a period of time, these numbers will come down as we get more flows from the external investors, and therefore this consolidation will not come in future.
Okay, so those particular schemes have gotten consolidated. That basically means that effect.
That's right.
And then as you raise more money, they will then later on not get consolidated.
That's right.
Okay, understood.
But as of 31st March, it's only one scheme which is getting consolidated, which is we recently launched the industry first, as Sandeep mentioned, the commodities fund. That is the only one which is getting consolidated. So what we do, we keep seeding the scheme, and then it keeps getting out as well, during the year.
So the 65 crore amount is for March 18, but as of March 19, only one scheme is getting consolidated. Is my
Right. That is 20 crore.
That is 20.
Okay, got it. So, and a little bit on the changes which have happened in the industry. First of all, because there's been a ban on upfront payment of commission, a lot of mutual funds have changed the way in which they're paying to their distributors. So there is like a fixed kind of a trail model, and there's also like a declining trail model. So for some of the funds are kind of paying 1 or 2 years a little higher commission, and then it drops off. What have we chosen, and how have we aligned ourselves both on this? And second is, can you just quantify with the TER cuts how much is the impact in bits on equity schemes, and how much of that are we passing on right now?
So see, on an overall basis, it is 2 to 3 basis point if you look at the total assets. But in terms of total equity, as Sandeep mentioned, it is about 12 basis point. Okay, and we intend to pass almost everything. Majority of that will get passed on, and that, if you recollect, during the February when this first TR cut came in, that also we have demonstrated we have passed majority of that. So that is your answer to the second question. In terms of the first question, see, all the distribution commission discussion is more proprietary to us, and we will not be able to disclose with you how exactly we are going about with the distributor. But I can tell you that in practice, with majority of our distributor, it will be completely aligned with the whatever is our earning, they will be getting a percentage share of that. So whether it is an IFA, a silver IFA to a platinum IFA to a bank, it will be proportionate to the earning, which is the DTER. We call it distributable TER. They'll get a percentage of that.
I think since on this question on TER, and I think our focus will continue to remain on profitable growth. I think whether upfronting or not, we will not be doing anything which we believe, A, from a compliance point of view is not right, and number 2, also, I think can affect the profitability. I think so. Most of our business is coming from IFAs, where the alignment is more on trail, which is good for both the investor and for us.
And one last question on the admin and other expenses. So obviously the outsourced services and some of the expenses which we were bearing, which were kind of a pass-through in our P&L, have been shifted to the scheme's P&L. Apart from that, also I believe that there has been a substantial reduction. It seems so. So can you point out how have we been able to achieve this cost reduction, and in what particular line items, if broadly, if you can guide us on that?
No, so of course we have been mentioning this in almost every Concall that we are working on the rationalization of cost. We have worked out processes. A lot of the processes have been automated, and also many of these non-core activities has been outsourced, bringing up savings in the operating cost. Also, as we have been mentioning, that a lot of our cost used to be discretionary cost, and where we used to mention that when the business is not so good, what we can do is we can put a tap onto it, and however we'll keep investing into these businesses both in terms of technology and in terms of our distribution reach, as and when the environment is conducive. And this is how we can demonstrate that when the environment was not good, we can bring down our costs at our flexibility.
And also, I want to highlight, I think over the last 4 to 5 quarters, I think we did a lot of investments which were to do with whether to open new branches, IT. All these things are right now, I think, to see whether the branches have been more productive now. I think the fact that 40% of the business, almost 40% of the new transactions that we are doing are coming through digital. All these things are also leading to operational profitability.
All right, sir. Congratulations again on a good set of numbers. Thank you. That's all from my side.
Thank you. Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in this conference call, please limit your questions to 2 per participant. If you have any further questions, you may come back for a follow-up. The next question is from the line of Jignesh Shah from MK Global. Please go ahead.
Hi, sir. And
Hi, Jignesh.
so, congrats on a good set of numbers. Just coming on the yield side, quarterly now our yields are getting stabilized. I'm saying about revenue yields at around 60 bips. Do we see this numbers to sustain at current levels, or you are seeing an improvement going forward on a sequential basis?
See, as I mentioned earlier in the call, that it is going forward, it will further improve because, obviously because this upfront getting divided over a larger amount of period. That is one. And secondly, what you have to see, this is, you have to see that if equity assets keep growing, the way in terms of proportion, then obviously these yields will improve. We have also mentioned in the past. However, we don't see this as, as this is then end to whatever strategy we are doing. Basically, if we see opportunity in ETF or we see opportunity in liquid or into fixed income space, we see that as a separate individual business line, and we continue to seize that opportunity.
Okay.
However, if particularly that if ETF grow higher in a particular quarter, then you will obviously see that yield declining on an overall basis. Similarly, if liquid asset grows disproportionately, the yield may go down that quarter. However, if the current AUM structure remains the same, then we believe that overall yields are going to be further improved because of this new TR regulation.
Understood. And is there any, apologies if I missed this number, but is there any amortized number still left? I mean, any expense or the brokerage amount which still needs to be amortized, or it is done now?
See, as far as the open-ended thing is concerned, it is completely amortized. No further amortization. And for the close-ended, wherever we have certainty of the fees to come in, those are the only amount which will be carried forward, and which is a very small number as compared to what we used to carry in the previous balance sheet.
Okay. Lastly, just two things. Just correct me. The total group company exposure, ADAC, you are talking about 380 crores, right now?
Yes.
And this is excluding home finance?
Yeah, there was nothing to home finance from the AFC balance sheet. It was, as mentioned earlier, 175 crores to infra, 150 to power, and balance was to AR.
Okay. And you are saying within next 4 to 6 weeks, an announcement might come out from the Reliance Capital side about the stake sale. That's the only thing you have.
That is what we've been made to understand. I will not be able to comment anything further as I mentioned.
Understood. Perfectly understood. Thanks a lot, sir, and all the best.
Thank you.
Thank you. The next question is from the line of Sagar Shah from SAM India. Please go ahead.
Yeah, hi. Hi, my question is to Pratik. I just wanted to understand on the employee expenses front. Are the bonuses accounted for in this quarter?
Yeah, absolutely. See, we have been mentioning earlier also that, we account bonuses every quarter uniform basis, and we keep doing adjustment for the businesses done. Obviously, large amount of our salaries comes to variable pay, and that gets adjusted every quarter.
Okay, perfect. And just on the yield realization on the equity AUM front, since this is the first full quarter in which there is no upfront commission which is paid on the new flows, what is the proportionate increase in the trail which you are seeing on the equity AUM front? Like, is it like 30 BPS or is it more than that?
No, see, the overall, as I mentioned earlier also, on the equity business alone, you have to see in three forms. Going forward, let's say if the current AUM remains, right? Current AUM can grow from here for three reasons. The first is if market appreciates without we getting any flows, there will be no impact whatsoever. Second, if the money comes through our existing SIPs, which is close to about 10,000 odd crore now, if it comes next year, again, there will be no impact to us in terms of realization. It is only the third part, which we get the newer flows. In that, if there is an impact, which used to be about 100 basis points, which we used to pay, if you divide this over a period of 4 years now, if we give that upfront, which we used to pay over the next 4-year period as form of a trail, then the total impact will be 1 to 2 basis points.
Okay, 1 to 2 basis points. Okay. Thank you.
Thank you. The next question is from the line of Anand Laddha from HDFC Mutual Fund. Please go ahead.
Hello, sir. Sir, just a couple of questions from my side. So on the P&L side, the fee and the commission expense which has been disclosed, this largely pertains to the upfront commission paid by us, which is getting amortized.
Yes, absolutely.
So, sir, if you can give some color, what is the outstanding unamortized commission expense still lying in the balance sheet?
That's a very minuscule number, which is close to about 50 odd crores.
Okay, so this will get amortized over the next 2 quarters?
No, see, this is, as I mentioned earlier, this is pertaining to some of the tax saver fund and retirement fund, and that will be amortized over the period of the life of the asset, which is it logged in.
Perfect. So
where we have certainty of the fees commensurate to that, it will be amortized.
Okay. But then this number can reduce significantly over coming quarters.
Absolutely.
Yes, absolutely. Okay. So there was some write back on the depreciation line item. If you can explain what is that and what should be the normalized depreciation run rate for us?
Okay. So see, if you know that we have acquired 2 years back asset management rights of Goldman Sachs mutual fund schemes, and those we have, as per the old accounting standard, we have decided to write it off over a period of 10 years. So we were homogeneously amortizing every year some amount of money. As per the Ind AS, amortization of intangibles are not allowed to be amortized over a fixed period of time. What you have to do is you have to test for its impairment. So if you notice that when we acquired the Goldman Sachs schemes, the total AUM was about 6,500 odd crore, and today we have close to about 24,000 odd crores of assets. And therefore, there is no impairment required, and it was advised by our auditors that you can't amortize it, and hence those have been reversed, whatever we have amortized for the last 3 quarters as well.
So last 3 quarters, we could have amortized 25 crore rupees in that, sir?
Sorry?
Last 3 quarters, we would have amortized 25 crore.
18 crores we have. See, 25 crores was to be amortized over a period of full year. 18 crores what we have amortized in last 3 quarters have been reversed in this quarter. Going forward, run rate would be about 2 to 3 crores per quarter of depreciation.
Okay. And sir, in the employee cost item, is there some still phantom bonus left to be accounted, or everything has been accounted?
No, so phantom bonus, as we mentioned, this is for about 5 years. Almost 3.5 years have happened, and all that has been accounted. The total cost for that is less than 8 to 10 crores. So about 80% of it is accounted.
Okay, so 8 to 10 crore are still left to be amortized.
That's right.
Okay. Sir, within the top line, if you can do break up, how much has come from the PMS advisory business, AIF business?
Sorry, come again?
Of the top line of 343 crore, or for the full year of 1,500 crore of top line, if you can give the number for the PMS advisory business, how much it is from the AIF business?
Yeah, so AIF business total top line is about 37 odd crore.
Okay, and what could be, sir, for PMS and advisory, sir?
So, all put together is about 100 crores, around 100 crores. Yeah, all subsidiaries and PMS advisory all put together is about 100 crores. Rather than giving the individual, the non-mutual fund revenue from AIF offshore advisory is about 100 crores.
Okay, and sir, lastly, sir, what could be our exposure to ADJ group in terms of exposure from the AMC and exposure from the schemes of the AMC?
I think Prateek already mentioned about, from the AMC, the number which was for about 425 crores last year is down to about 380. So that is what is basically from the AMC. From the mutual fund schemes, the total exposure starting of the year was 3,100 crores, which has come down to 1,750 crores. And out of which about 1,000 crores roughly is due for maturity in the next 2 to 3 months. I think we are confident that we will be able to recover that.
Perfect. Sir, is there any way that we have been also looking to buy the securitized asset of the group? Or we are investing in any of the securitized asset of the group?
I think as the portfolio teams keep looking at the various PTCs across the industry. So we have PTCs of more than 10 different, about 8 to 10 different corporates, because these are off-balance sheet thing. So there are about 8 to 10 different corporates. We have the off-balance sheet PTCs from them.
Fine, sir. Thank you, sir. That's from my side.
Thank you. The next question is from the line of Harish Nagappa from Aditya Birla. Please go ahead.
Hello. Hi, Sandeep. Congratulations on your number, firstly. I just wanted to know about your expansion strategy. What is the ratio of number of branches in T30 and B30 cities? And what is the number of customers acquired this year from T30 and B30 cities?
I think from our perspective, I think if we were to look at it, we are present in 300 locations at this point of time. Majority of our branch network is in smaller cities and towns. This year we added about 9 lakh new folios, new investors, and about 80% of these investors came from smaller cities and towns. I think from our perspective, I think we clearly see both the online and offline strategy play a big role. As I mentioned earlier in my speech, 40% of the new incremental transactions that we are doing through digital. So both, and also the new branches which we had opened over the last 12 to 18 months, out there also we are seeing a lot of new investors coming in. So clearly going forward, the branches we run, branches and the technology investments which we have done, we will see them contributing significantly in this the coming financial year.
Any exclusive numbers? How many branches you are going to open this year?
I think we'll don't want to put a number, but it will not be very huge. I think we want to move the branches which we have opened. I think we want to stabilize there.
Okay, one last question. What is your direct customer base, excluding the Insta customer base? Pure direct base, and their AUM.
So, I think 14% of our investments in equity are direct.
Equity, okay.
Yeah. And because overall number is not relevant because majority of the institutional money that comes in comes direct.
Okay. So you have any number, excluding how many folios are there direct customers?
I think this is overall AUM because I think from a revenue perspective, what is more important is the AUM. I think we can share that with you sometime later offline.
Thank you.
Thank you. The next question is from the line of Rohan Advant from Multi-Act. Please go ahead.
Yeah, sir, thanks for the opportunity. Sir, I wanted to understand the impact of change from upfront to trail on our profitability a bit better. You mentioned that the 1% upfront, which was paid and amortized over 12 months, would now be paid and amortized over 48 months, which is resulting in the profitability jump post-change versus pre-change YOY. But wouldn't this also mean that starting year 2, there will again be a 25 basis points cost for this versus 0 when there was only upfront, and so profitability should actually reverse YOY starting Q4 FY20, or am I missing something in this?
See, as I mentioned to you earlier, that you have to see this whole thing in 3 parts. One is the total assets what we have as of today, which is the book. On the book, there is no change which is happening because there is no increased trail which is happening. So in terms of the SIP which is already been registered and coming in, there is no change into that. The assets going up because of the appreciation of the market, there is no change in that. So total earning comes from 4 areas. One is your existing asset, existing SIP which is coming in, market going up due to the appreciation, and the only last bit is the new flow which is coming from the new investor. Now that is where only the change will happen. So even if you assume that, let's say asset base is 100, a 10% of that comes from appreciation, 10% is anyway coming from your SIP book, and then 10% comes new. And on that new 10%, if we say that you're going to increase the trail basis by 20 basis points. So that means only 2 basis point overall impact will come on the total assets.
Got it. So 2 basis points adverse impact if nothing else changes. Of course, there could be operating leverage, etc. But only because of this, 2 basis points adverse impact could come, right?
That's right.
Understood, sir. That clarifies my doubt. Thank you.
Thank you. We would request participants to please limit your questions to 2 per participant. For any further questions, you may come back for a follow-up. The next question is from the line of Nischint Chawathe from Kotak Securities. Please go ahead. Nischint Chawathe from Kotak Securities, your line is unmuted. Please unmute the line from your side and go ahead. As there's no response, we take the next question from the line of Shrey Singh from Kotak Securities. Please go ahead.
Hello. Yeah. Good morning, sir. So just one small data keeping question. So how much is the fully diluted share count adding the ESOPs?
As of now, it is 61.2 crores is the total outstanding amount of shares.
61.2 crores.
Yeah.
Okay. Thank you, sir.
Thank you. The next question is from the line of Shubhranshu Mishra from Bank of Baroda Capital Markets. Please go ahead.
Right. Thank you for the opportunity again, sir. Just want to understand the outlook of the AUM growth in FY20, and if you could explain the split, how much would come out of B30 and D30, and also if we can understand the split between equity, debt, and liquid funds.
That's like a complete business plan for the next 5 years. But
no, I just wanted for the next year, so not 5 years.
No, next 1 year also. I'm trying to do that for justice in the next 2 seconds. So, I think we clearly believe, post the election,
right?
I think this year we have seen basically subdued, flows in the industry. And typically, if you look at the industry over the longer period of time, you always have after 1 or 2 years, you have 1 or 2 years, which are a little subdued. I think we've been seeing a lot of money which is beyond the sidelines, but I think because the fact that investors for the last 1 year returns have not been very good, they've been holding back the investment. I think clearly see from a growth point of view, while can't share what will happen in the next 1 year, our view is industry will continue growing at between 20 to 25%. If you were to look at a 5-year period, clearly I think from our perspective, I think the flows coming from, while I think clearly there's going to be the flows will keep increasing, the higher volumes will come from bigger cities. But we clearly, I think our belief over the last 15 years has been the kind of wealth that is being created in the smaller cities and towns and the lack of other options being available. I think the penetration in smaller cities is going to just keep increasing at a faster pace. And I think our focus, I think clearly will continue while we keep operating in the bigger cities. But in the smaller cities is where I think we believe the growth will be much faster. And I think where we have an established distribution platform, and I think we believe we can gain disproportionately there. Having said that, I think with the breakup between debt and equity, I think very difficult to put a number to it. But clearly, I think clearly see the equity flows to be higher over the next 2-3 years compared to debt.
Right. So thank you for that. Just want to clarify one thing. You would be growing at the similar industry levels or a bit higher than that, sir?
I think the stated policy is, I think for us the profitability is more important.
Right.
So from a profitability point of view, our endeavor will be with the kind of scale and the operating leverage we have, we should grow better than the industry. As far as the AUM is concerned, we are very clear. I think as a stated policy, I think as advised by the board, we are not basically into a top line game. I think for us, profitable growth is more important.
Sure, sir. That's helpful. Thank you for your time, sir.
Thank you. The next question is from the line of Ankit Pawar from IIFL. Please go ahead.
So this is regarding the diluted share count again. You mentioned that there are 61.2 crore shares outstanding, and also recently you have issued about 11 million ESOPs. And 11.19 million ESOPs, can you please tell a count of ESOPs outstanding currently, and what is the likely kind of dilution in the next 1 year and 2 years?
At this point of time, the total grant that has been given to employees is about, including yesterday's, which has not been vested. I mean, the grant that has been given is about 2.75% of the company.
Okay.
The endeavor will be, I think, going forward to take it to, while the number is yet to be decided, but I think clearly, I think is to have higher ESOPs, because I think from a long-term point of view, clearly believe, I think the PLI and the fixed cost will keep coming down basis that. And difficult to give a number to it, but you will see further ESOPs over the next couple of years.
Okay, and what will be the exercise, tentative numbers for FY20 and FY21, year-end numbers?
I think Pratik can give you offline after this.
Sure. Thank you.
Thank you. Ladies and gentlemen, as there are no further questions from the participants, I would now like to hand the conference over to Ms. Mona Khetan for closing comments. Mona, please unmute the line from your side and go ahead. Members of the management, would you like to add any closing comments?
Thank you very much. And I think look forward to interacting with you in the next quarterly call. Thank you.